When people first start investing in the stock market, they often dream of becoming rich overnight. But the truth is that most beginners make the same costly mistakes that can easily be avoided with the right mindset and strategy. The first and most common mistake is trying to get rich quick. Many new investors rush in after hearing about a trending stock on social media or from friends, expecting instant profits. They forget that the stock market rewards patience, not panic. Short-term hype often leads to emotional decisions. Buying when prices are high, out of fear of missing out, and selling when prices drop out of fear of losing everything. This is called emotional trading, and it's one of the fastest ways to lose money. The second big mistake is not doing proper research. A lot of beginners invest in companies they know nothing about, simply because the stock looks popular. Understanding what a company does, how it makes money, and whether it's growing steadily is crucial before buying its shares. A wise investor once said, "Never invest in a business you don't understand." The third mistake is putting all your money into one stock, also known as lack of diversification. Imagine if you spent all your savings on one company and it went bankrupt, you'd lose everything. Spreading your investments across different sectors and industries helps protect you when one area performs poorly. This way, your losses in one stock can be balanced out by gains in another. Another common error is ignoring the importance of long-term thinking. Many beginners expect results within days or weeks, but real investing is a marathon, not a sprint. History shows that the stock market grows over time despite short-term ups and downs. If you invest consistently and hold quality stocks for years, your money can grow through the power of compounding, where your profits earn more profits. Yet many new investors panic when they see prices drop, forgetting that market dips are normal and often temporary. The fifth mistake beginners make is not having a clear plan. Investing without goals is like driving without direction. Before putting money into the market, it's important to ask yourself why you're investing. Is it for long-term growth, retirement, or a short-term goal? Once you know your purpose, you can choose the right strategy and avoid chasing random opportunities. Another big mistake is trying to time the market, constantly buying and selling based on predictions. Even professional investors find this nearly impossible. The best approach is to stay invested and be consistent, rather than guessing what will happen next week. The next mistake is ignoring fees and taxes. Many beginners forget that every trade comes with small charges, and those can add up over time. Using high-fee platforms or buying and selling too often can eat into your profits. Always check the costs and understand how capital gains tax works in your country. A subtle but serious mistake is following the crowd. It's easy to get carried away when everyone seems to be making money on the same stock, but markets move in cycles, and by the time most people start buying, the price is often already inflated. Independent thinking and discipline are what separate successful investors from emotional traders. Another big one is failing to review and adjust their portfolio. Just like your health checkups, your investments need regular check-ins to see what's working and what's not. Some beginners forget about their investments completely, missing chances to rebalance or take profits. On the flip side, checking too often and reacting emotionally can also be harmful.